IAS 7. And for IAS 7, it's basically statement of cash flows. All right. I'm very, very sure that it must have been introduced to us when we were doing IAS 1 with Mr. Wasiu. Very important standard. It looks like the introduction and all that, but very, very important standard. That standard, and of course, the conceptual framework of IFRS should have opened you up to what is called the elements of a financial statement. There are 5 of them. You would have spoken about assets, liabilities, income, expenses, and of course, equities. All right. And that conceptual framework would also have opened you up to the fact that we use accrual basis of accounting. The IFRS really focuses on accrual basis of accounting, right? Now, there are as well 5 components of a financial statement. 5 components, meaning that when I'm looking at the financial statement of any company, I should be expecting to see 5 important components there. And what are those components? We know them. First of all, we'll talk about the statement of profit or loss and other comprehensive income. We'll talk about the statement of financial position. We'll talk about the statement of changes in equity. All right. Now, all of these statements, they have no distortion whatsoever to do with accrual basis of accounting. It's in line with accrual basis of accounting. And what is accrual basis of accounting? It means that we are not giving credence to when cash is paid or when cash is collected. Rather, what we are interested in is when we must have earned such incomes and when we must have incurred such costs. And then we will record the payments and the receipts afterwards. But first of all, we take recognition of the fact that we have earned some incomes or we have incurred some costs. Now, what this does is that it means that your attention is not on the ability of the company. There is no measurement. If you look at those 3 statements I mentioned, statement of POL and OCI, statement of financial position, statement of changes in equity. There is really no consideration for the ability of the organization to generate cash flows. All right. And we already know that cash is king. Why do we say so? Because it's really your ability to generate cash that gives us a level of assurance that you can continue to stay in business. If you are generating sales and you have a problem receiving monies from the people you have sold to, that you have sold to on credit, then it's only a matter of time the business is going to run down. Okay, so IAS 7 is channeled towards ensuring that this statement of cash flows is prepared accordingly. Now, it's not one of the most stringent or most what do we call it now, one of the most rule-based. It's not even rule-based. The whole of IFRS is not rule-based, but IAS 7 is one of the most flexible in terms of how statement of cash flow is approached according to IAS 7. All right. So what we are going to be doing today is very simple. You just want to open you up to how you're going to prepare your statement of cash flow in very, very, very easy steps. You will see that I already sent you two questions. Those are the questions we'll look at quickly in the class. Or maybe it depends. I don't know. We may be able to consider the two of them. We may do one, but even with one that we would do, I believe that you would understand what the statement of cash flow, how it's supposed to be approached. Now, um, how does what is the aim of the statement? I already told you that the aim of this statement is to ensure that we are able to see the ability of the company to generate cash flows. We want to see the cash flows that the company has generated. All right. Now, so what the statement really focuses on is looking at what are the payments that we have made, and what are the receipts that we have. The receipts that we have collected. All right. Now, this statement also, according to IAS 7, we are going to look at the movement of our cash and cash equivalents. Now, in terms of cash and cash equivalents, we really want to know our cash or bank, or let me say cash and cash equivalent, is moving year on year. Last year, like, was it this class I was saying this to? That one of the things that differentiates a normal accountant and every other non-accountant is this: when you tell a non-accountant that you have realized the profit of 1 billion naira, the person would expect that it means that you have 1 billion naira cash. But you and I know that that is not true. It does not necessarily mean that they have 1 billion naira. In fact, the company may not have even generated that cash, because they will always have payments that are probably yet to be made. They also have receipts that they are yet to receive or to collect. All right. So now, when we look at the movement here on this cash and cash equivalent is one of the current asset line. Abi? Now, that's one of the current asset line on your SOFP. So what we are looking at is this. We want to see the changes that have occurred here, and the statement is really going to help us to analyze how those cash flows were made. Okay. So now, in terms of defining cash and cash equivalent, very easy. So we have cash, two things, right? We have cash, all right? And then we have cash equivalent. Sorry. We have cash equivalent. Now, under cash, you see cash and bank. That's the most liquid state you can have, or your bank balances. Very straightforward. You could also have your term deposits. Your term deposits. And when we say term deposits, we're looking at something such as what you call your fixed deposit. It means that you have such an amount with your financial institution that for a while you would not have access to. Now, you don't have access to it, but over a period of time. But that period of time, or what we call tenure, is usually a period that is less than 90 days. Less than 90 days. Usually less than 90 days. However, it does not mean, even if it was higher than 90 days, The reason why we will still consider it cash is the fact that you have access to always receive this amount of money at any point in time. Last, what will happen is that your financial institution will tell you that because you pre-liquidated, they are going to charge you some penalty. How many of us have experienced this before? Where you have a fixed deposit with the bank, and one of the clauses that, or one of the terms that you will see on the letter of deposit or letter of investment will be that if you say you want to liquidate, they will give you your money. The only thing is you will suffer a penalty on the interest, meaning that your initial deposit is still safeguarded. So IAS 7 considers this as cash. It is still cash. Now, what do we consider to be cash equivalent? Any such instrument that the maturity of the instrument is expected to be less than between 0 to 90 days. It could be your treasury bill. Your treasury bill will do you have treasury bills of 91 days. It could be a commercial paper. It could be a call money. Whatever form of instrument that you have that you are expected to receive your money, that is maturity of that instrument is less than 90 days, then we can classify it under cash equivalent. All right, we can classify it under cash equivalent. However, even the standard was specific about certain things. That's why I said, cash and cash equivalent is a little bit technical than you would expect. Now, what are just one or two things? I don't expect ICAN to ask you this, but it's just better that we lay this foundation. What are those things that will not fall under cash equivalent, even if it were to mature in less than 90 days? The standard makes specific point of equity. If a company says, I'm sure you must have done IFRS 9 with Mr. Wasu. If a company says they have financial assets, equity, and their intention is to sell, such as their business model is, we are going to do fair value through profit or loss, and they tell you that their intention is to sell at a day that the number of days they intend to sell is less than 90 days, it still will not qualify this instrument to be treated as a cash equivalent. I want to believe this is clear. It still will not qualify. So even if you have any form of hybrid um, um, instrument, when I say hybrid, I'm talking about things like preference shares, you understand, or you have such an instrument that is a convertible, what is it called? It will not come, once it has any component of equity in it, it will not come under cash equivalent. Is this clear, everybody? Before I move on, is this clear?
Let's move on, so I will get it more.
So we'll get it more. All right. Okay. So that is that. The next step is this. The statement is going to be in 3 subsections. Some of us would know this, some of us may not. 3 sections. There are 3 sections that IAS 7 detailed the cash flows. What are those 3 sections? The first one is operating activities. Okay. Operating activities. I'm coming. Operating activities. Number 2 is investing activities. Investing activities. While number 3 is financing activities. It's really a struggle today. Operating activities, investing activities, and financing activities. So, what are these things that we are calling operating activities? Operating activity is looking at the primary activity of the business. For instance, equity professional tutors. What are the operating activities for equity professionals? They are engaging in the business of providing tutorial services to candidates of ICAN exams. So therefore, their operating activities will include things like paying the lecture fees for lecturers, all right? It will include things like collecting tuition fees from their registered students, all right? It will include things like rental for the space that they are using for physical class. It will include things like subscription for the premium account that they are using for virtual classes. It will include things like buying markers and other consumables that will be used in the classes. So these are things that are associated with the primary focus of the business. Or you can say things that pertain to the day-to-day running of the business. We are looking at the incomes that come from the primary focus of the business, and we are looking at the operating expenses, the day-to-day expenses for them to achieve that primary focus of the business. That is your operating activity. Now, if that is a lot of English for you to absorb, it's very easy to look at operating activities from two places. I am going to look at the P&L. I am going to look at the P&L to see the activities there. I am then going to also look at the current assets, and also look at current liabilities. Current liability. Those are the 3 things: P&L, current assets, and current liabilities. Why current assets and current liabilities? Because this is how you will get your working capital. Your working capital is that capital you use to run your day-to-day activities, right? And then to get that working capital, you do current assets minus current liabilities, right? Okay. The same thing will go for P&L. Why am I looking at P&L? Because that is where I am going to find my OPEX, my operating expenses. And that is where I'm also going to see my operating income, the incomes that I generated from actual sale of goods or rendering of services. That is the primary focus of the business. Now I'm going to differentiate some things when we get here. When it comes to investing activities, what we are really looking at here under investing activities, we are looking at things that we invested in. No, let me say invested. Cash flows that we paid or we received as a result of the way we have used our non-current assets. So here, my focus will be on non-current assets. Non-current assets. So what am I really talking about? Look at a non-current asset item such as PPE. PPE, right? So PPE is very important to achieve what we are doing. So if we decided to acquisition of PPE, that will be an investing activity. Another investing activity will be disposal. Now, when we acquire PPE, we are going to cash out. That's cash outflow, right? Money goes out. When we dispose PPE, we sell one of our PPE. What we will do is we will receive money, all right? So that's in terms of PPE. There could be acquisition, there could be disposal. Another activity under investing is we could have decided to buy new investments. It could be investment in associates, it could be investment in subsidiaries, or it could just be for accretion of wealth. So in associates, investment in associates, in subsidiaries, etc. Those are also investment. Maybe you invested in equities of a company, even if it is for accretion of wealth, it is still under investing activity. Also, when you do this, it's a payment, it's an outflow. Now, because you have invested in an associate or a subsidiary, or it's just an equity investment for accretion of wealth, you are bound to get, let's say, for instance, dividend. The dividend you received will be an inflow, all right? You could also have sold those investments, sale of shares. Now, mind you, I didn't say issue of shares. When you issue out shares, it will not come here. But when you sell shares of another company that you bought, that will be under investing activities as well. We could also have invested in debt securities, such as bonds, such as treasury bills. It could be short term, it could be long term. It will also come into investing activities. All right. Now, finally, we're talking about financing activities. Now, there are two things that finances the assets of a company. It could either be equities, equity capital, or it could be non-current liabilities. These are the two things you're going to look at. Whenever I want to do financing activities, I should be looking at the non-current liabilities, and I should also be looking at the equity capital. Now, what are the breakdown of the equity capital? Under equity capital, I have ordinary share capital. Now, under ordinary share capital, if we issue of new shares, this will be a financing activity. If we do right issue, this will be under financing activity. When we issue those shares, we are going to collect monies. People who subscribe will collect money. That money we have collected will be it will be a cash inflow under financing activity. All right. Now, under that, we also have share premium. If we issue shares, there's a possibility, or in most cases, we would have issued at a market price that is higher than the book value of the ordinary share capital. All right. Whenever we do that, it will give rise to share premium. That movement on the share premium is also going to be regarded as a cash inflow for financing activity. All right. Again, under equity, we have what is called retained earnings. All right. So okay, we've not done IAS 33. We're still going to do that very soon. But even if we've not done that, one way or the other, I'm sure you must have seen changes in equity. Now, one of the things that causes retained earnings to change is the profit. No problem with that. That's not cash. But something that is cash that can also affect retained earnings is called dividend payment. We may have made a dividend payment. This will be regarded as financing activity. The reason is that this is a payment we are paying to our capital contributors. All right. So dividend payments will also come under financing activity. Madam Aisha, please help us mute. Now, let me quickly make a a distinction because you can see dividend here as well. This dividend received. This is dividend received. If we are receiving dividend, it's because we made investments in another company. But if you are making dividend payments, it's because other people invested in us. So other people financed the assets that we have, and we are making payments to them. So such dividend will be under financing activity. But when it is dividend received, what it tells you is that you were the one who invested in another company. So investing activity. So when you receive dividend, investing activity. When you pay dividend, financing activity. All right. Now that's simple and clear. Do we have any questions so far? Do we
Yes,
have
please,
any
I do.
questions? Okay, you do.
Yeah, I have a question.
All right, please go ahead.
Yeah, please, I need clarity. I just joined now. I need clarity on that financing activity and because I need clarity. Seriously, I think this is my second time taking EPA, so I don't know.
Okay.
Yeah,
Okay.
thank you.
All right. Okay, let's look at it like this. Financing activity, very straightforward. You have your accounting equation. The way your SOFP is done, statement of financial position, it is done in such a way, according to IAS 1, it is done in such a way that you have total assets, Abi, and then you now have equity plus liabilities. All right. So I'm now saying what the way they did that statement of financial position, or if you like balance sheets, the way they have done this balance sheet in this IFRS is to let you understand that what finances your total assets. If a company has assets, all those assets were financed by two set of people. Who are the two set of people? Number one, the owners of the business. That is equity capital. Abi? Number two, it is third parties who you are using their capital. And what are you going to call those third parties? You will call them liabilities. All right? Now, under liability, we have current liabilities. If you look at the nature of current liabilities, you have to pay them in a very short period of time. So we will not really count them as financing the business in the long term. The people who will count as financing the business in the long term will be the non-current liabilities. Now, I am not defining financing activity to you. I'm telling you where to look whenever you want to deal with financing activity. You should look at your equity and look at your non-current liabilities. What are the movements you see there? For instance, ordinary share capital may have increased. If ordinary share capital increased, then it must mean that the company has issued new shares. So that issuance of new share is a financing activity. You have already detected that. The next thing will now be, is it an inflow? Did money come in or did money go out? When we issue new shares, we are asking the public to contribute capital to the company. So what we are doing is we are receiving money from the public. That is cash inflow. Number two, I said if we issue new shares, in issuing new shares, we may have sold, or we most likely would have sold at a market price that is higher than the book value. All right. Now, whenever that is done, what it means that it is going to give rise to share premium. So look at your share premium. Is there a movement there? It is going to be associated, most likely associated with the issue of new shares, the two of them together. Is it clear? Then we can move to retained earnings. I'm now saying your retained earnings. What really drives your retained earnings is the profit for the year. All right. But whenever companies make dividend payment, they are making that dividend payment from the profits that they have retained in prior years. So dividend payment is also what? A financing activity. What it means is that people contributed capital to you. Those people that bought those new shares. Remember, I mentioned new shares. So the people that bought those shares, you have now made profit. From the profit you have made, you are now giving them money out of it. It's still a financing. What gave birth to that transaction was the financing that you received from them. All right. Now, all of this, we are looking at equity. Abi? Now, away from equity, when I go to non-current liabilities, I'm looking at loan. I'm seeing a loan term, maybe 12% bond, blah, 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 blah. What it means to me is that outsiders are financing the assets we have. All right. If there is an increase in the loan, what it means is that we most likely have, okay, there are two things that are going to cause the loan to increase. Number one is interest. Interest could have caused it to increase. All right. Now, number one. Number two is that it could also mean that we have taken up new loans. Number three could be that if in a more complex question, they may just twist and turn and tell you that the loan term has changed. So which it may lead you to accrue more loans. So if you have more loans, what is that? The new loans that you have is a financing activity. If you have to make payments for interest payment out of that loan, it is also a finance, because somebody gave you money, they finance the assets you have, and now you have to pay them in return. So your interest payments and your loan principal repayments, the two things will fall under financing activities as well. So it's about knowing where to look. When I'm doing operating activities, I know where to look. I'm going to look at some items I need to adjust for in the P&L. Some items I need to show the movement on current assets and current liabilities. I move away from that. I get to investing activity. I'm looking at non-current assets. What are the movements I see there? What are the things that explain the movement in my PPE? Was there acquisition? Was there disposal? What are the payments that have been made under that movement? That is what I'm going to account for there. When I'm looking at financing activity, I'm looking at equities, I'm looking at non-current liabilities. What are the movements that I'm seeing there? What are the things that could have led to cash inflows and outflows? And I must be able to account for it. And that is what I will do. Immediately you do this, you will see that your cash flow will always balance, always balance. And even if it doesn't balance, I'm going to give you a trick. There's a trick that you will use to know where the issue is coming from. I do that all the time in practice. I didn't know it when I was writing ICAN. It was when I got into practice, I got to understand that. But before I move on, Madam Janet, is it clear now?
Yes, it is. Thank you.
All right. So what will happen is this: after the class, I will share a template, but I want to show us just a random template now. Okay, before we even go there, I'll work on that. Now, when it comes to operating activities, IAS 7 says there are two ways to approach it. It says there is a direct approach or method, and that there is an indirect method. IAS 7 says we can have direct and we can have indirect method. There's not even no need to bother. I'm going to share a note with you that will show you all of these things. All right, you will have a template in the note as well. Now it says they are direct, and then we have what is called the indirect, the very indirect approach. Now, today I'm going to teach us indirect. This is the most common and the easiest. And then in another class, we're going to do direct. All right. Okay. So let me scribble what a typical cash flow statement look like. How many of us can see what I'm showing now?
Excuse me, sir.
I'm listening.
So is it possible for us to have it as soft copy the way you forwarded to the question on our WhatsApp page? I think you will, so that.
Yes, exactly what I was saying. Exactly what I was saying. All right.
Okay.
Thank you. So what you have here is a typical example of indirect method. Now, under operating activities, we can have direct and we can have indirect method. Now, we are looking at indirect method. For indirect method, first of all, can you all see my screen? Can you all see what I'm showing on screen?
Yes, I can see your screen from here.
Okay. All right. I want to believe it is the same thing for everybody. All right. So for cash flows from
Yes.
operating activities, we are reconciling from the profit. Okay. From the profit. Now, we have made profit. Like I said earlier, when you tell a non-accountant, we made XYZ profit, the expectation is usually that, oh, that means they have XYZ amount in the bank. No, that's not true. And the reason it's not true is this. Number one, we have expenses that we deducted from the profit or from the income we have generated that are not cash expenses. They are non-cash expenses. A very good example is what you've seen here. Depreciation. Depreciation is an example of a non-cash expense. Amortization is another example. We might have amortized. We might have amortized some intangible assets, all right, that don't represent actual cash flows. We also may have amortized some form of prepayment. And what we are looking at is not the amortization. What we are looking at is the actual cash flows. That's number one. Number two, that we also need to make adjustment for will be incomes that we generated that are not primarily from operating activities. A very good example is what you are seeing on your screen. Gain on sale of plant assets. This is gain, or what do we call it? Gain on disposal of PPE. If you have sold PPE and then we received money, we made a gain. That gain we made is not a gain from operating activity. That's not the primary activity of the business. It's like equity professional. We have a generator now, for instance, and we've had that generator for a while. And then we decided that we are going to sell it off because we have been using it for a while and the efficiency of the generator no longer meets the requirement that we want. All right. We now decided to sell it to one of the lecturers or to an outsider. Now, that income we will receive from the sale of that generator is not going to be a operating activity cash inflow. The reason is simple, because that is not our primary business. That's not our primary business. Our primary business is to render educational and tutorial services to ICAN candidates. So it does not fall within the purview of what we are primarily doing. So therefore, we will need to make an adjustment. So these are the first two adjustments that you are going to make. You are adjusting for number one, non-cash items that were either added or deducted from your profit. You will add those expenses back, and the ones that they were incomes, you are going to deduct. If you have any form of income that is not an operating activity, we are going to deduct it because it was added to profit earlier. And if it was an expense that is a non-cash expense, we're also going to add back. That's the first level. The next level under operating activity then will now be the issue of working capital. What am I referring to here? Current assets and non-current, current assets and current liabilities. If you look here, you see accounts receivable decrease, you see prepaid insurance decrease, you see accounts payables increase. All right. Now, this is just showing us movement in working capital. Now, that movement in working capital, what do I need to pay attention to here is that whenever it is assets, whenever it is current asset, I will do the opposite. Whenever it is current liabilities, I will do it as it is. What do I mean? If I am dealing with current asset, if current asset increase, what I will do is I will do a minus. The meaning of that is this. We say, if, for instance, your account receivable increases, if your account receivable increases, for instance, let's say, for instance, your closing balance in previous years was 1,000. In the current year, your closing balance is 2,000, meaning it increased from 1,000 to 2,000. What could have caused that? What could have led to that increase? What would have led to that increase would be that you gave out something that is worth cash that you are yet to receive money for. So we will treat it as an outflow. We will treat it as an outflow. In the same vein, if the same account receivable had decreased, if there was a decrease in account receivable, what it means is that you had people owing you 2,000 naira before, and now people are owing you 1,000 naira. Then you must have this. So, like I was saying, so bear in mind there are two segments that you are going to deal with. The way I'm going to solve with you in this class, I'm not going to do operating activities together. I won't module it together. What I would do is to first of all adjust for those non-cash expense and activities that don't belong to operating activities that must have been modeled together. We'll do that. Then we will now do changes in working capital. And when I say changes in working capital, what I'm referring to is the change in the current assets and current liabilities. Lastly, I am going to look at tax. If there was a tax paid, if by the movement I can see that tax has been paid, because it will not come to you directly. They may not even mention it to you that tax has been paid, but you are supposed to do a walk back and see whether tax has been paid. If tax has been paid, I will deal with it under operating activities as well, because tax is levied on profit that we have generated. All right. So, and that is an operating activity. So I'm going to deduct that tax paid there as well. All right. And then I'll move on to investing activities. When I get to investing activities, you can see the examples that they have here: cost of new plant asset, cost of investment purchased, proceed from sale of investment. All of these are items you see in your non-current asset. So your non-current asset is where you are going to see your investing activity. Don't ever forget that. That's where I expected to see it. Now, what you may not see there that is an investing activity is interest income. Whenever we have made an interest income, don't forget that if you are receiving interest income, it is most likely because you have invested in a debt security. All right. So if you receive interest income, most likely, although this is not, that is why I said IAS 7 does not give rules. If you look at the nature of the interest income, most of the time, 80% of the time, it is an investing activity. So what we will do is we will deduct it under operating activities, but then we'll come and add it as an investing activity. That's an example of something that may not be so glaring to you. That is an investing activity. All right. Interest income, that is interest that we received, not the one that we paid. All right. Okay. Now, when we come to financing activity, I've mentioned all of this one too. You can see issuance of common stock, payment of dividend, payment of notes payable, meaning that we try to reduce our loan. Okay. Somebody financed us with loan and we are repaying back. When they financed us with loans, a financing activity. So when we are paying back too, we will refer to it as a financing activity. This is very different from we went to go and buy raw materials. Buying of raw materials and repaying loans are two different activities entirely. We are buying raw materials, operating activity. That's our primary business. But when we are repaying loan, it's not our primary activity. But because somebody financed us and we are now have to pay that person back, so therefore will be a financing activity. All right. I'll stop sharing this and I'll go to the question that I had shared with us initially. All right. So we have a very straightforward question, but very good for us as starter. Very, very good for us as starter. So let's look at the question. Kane's Co. income statement for the year ended 31st December 2022 and statement of financial position as at 31st December 2021 and 31st December 2022 were as follows. Kane Co. income statement for the year ended December 2022 were as follows. Income statement for the year. We're giving the sales, raw materials, staff costs, depreciation, loss on disposal of non-current assets, operating profits, interest payable, profit before tax, taxation, profit after tax. Okay. And then we have the statement of financial position. And then get used to this. You will be given the statement of financial position for 2 years. Statement of financial position for 2 years. All right. Okay. Now, whenever this is done, you could expect to get 1 or 2, 3, 4 additional information. Now, the additional information is usually to guide you, to help you into knowing what payments have been made and to explain some movement. All right. Now, let's get into it. Let's get into it. Um, mm, Space. I'm going to need space. All right. Do we have this today? I'm sorry about how this class have gone. I will not be able to screenshot and send to the group because my WhatsApp is not added to this system. How do I go about this? I won't be able to. But something we can do is to go like this. You can say Cane Co. No, definitely not this color. So we can say.
Red will be preferable.
What did you say?
I said red color will be better.
Yeah. So we can say profit before taxation. So I have Naira. Sorry. I have Naira sign like this.
Operating activities.
Statement. Thank you, Mr. Latif. Statement. Oh God, I wish I could just write straight. Statement of cash flows. For the year ended Aisha, any issue? Year ended. 31st December 20x2. And then you start with cash flows. Hey God, who is that? Sorry, all this scribbling. Cash flows from operating activities. Kai. Activities. Are we going to sleep here? All right. So I said first thing first, profit before taxation. Permit me to just write PBT. Now, if you check the PBT was how much? PBT was how much? PBT was 392,000. PBT was 392,000. Hey God. Someone says this handwriting is too foul. I can't see with my glasses. Hey God. Okay, let me try something.
Sorry, try and let us screenshot the question if the question is the problem, so that you can open a new page so that we can do the workings, since you can't share through your own WhatsApp.
Okay. Somebody can do that.
So just share the question the way it is so that we can capture it. Then we can share it on the on WhatsApp so that you can open a
So
new
you want
page.
me to move to the upper part of the question, Abby?
Yes. Yes, makes it better.
All right, I think I'll use Excel. Sorry. Let's go. Okay, for the year ended 31st December. Can we all see my screen? Can we all
Yes.
see my screen?
Yes, sir, we can.
Yes, sir. I think this
All
environment
right.
is okay.
All right. From operating activities, right? So I said we'll start with what is it called?
Profit before tax.
Profit before tax. Always on point. Thank you. All right. So we have profit before tax. And that was how much? 392,000. Okay. Now I'm going to do adjustments for non-cash items. Non-cash items. All right. And the first thing I want to do for will be depreciation. All right. So first thing first, were we giving depreciation in the question? If you go to your SOPL, you will see it there. They said depreciation was 118,000 naira. Some questions will not give it to you like this. Some questions would not have given it to you like this. Okay? 118,000. Not a problem. The other thing I'm going to see there, do I have any other non-cash item that I must deal with? Yeah? No.
Yes.
Which one? Which one? Go ahead.
Okay.
Loss on disposal. Yeah, you are right to say non-cash, but I will not treat it on the basis of non-cash. I'll treat it as an item that is not operating activity. Do you understand what I'm saying? An
Okay.
item that is not operating activities or items not operating activities. Either of the
Sorry,
two.
Abayomi. What
Mr.
about the
Abiodun?
Abiodun? The depreciation in the SOFP.
Okay, we are going to deal with that. We'll deal with that. That is how we are going to know the disposal and acquisitions. Okay, I'll just do my workings here for that one. All right. Okay, but depreciation charge was given to us. Okay, but if it gives us comfort, maybe we'll just have that. Let's start with PPE. What gave birth to depreciation is PPE, Abby? All right, now. What was the balance brought forward? I'm talking about balance as at the end of 20x1. Balance as of the end of 20x1 was how much in this question? Let's go to SOFP
1,000.
now. 1,560. 1,560. Good. 1,560. So at the end of the year, okay, let's even look at the additional information we were given. They gave us an additional information. They told us, they said dividend paid were 66,000 naira. And then during the year, the company paid 90,000 naira for a new piece of machinery. We paid 90,000 naira for a new piece of machinery. Now, if we paid 90,000 naira for a new piece of machinery, it means we made additions, all right,
Yeah.
of 90,000. Now, if you add these two together, you get 1,650. But somehow, the balance carried forward, that is at the end of 20x2, was how much? The balance carried forward was how much? 1,000?
5 something.
5 something.
1,000.
596.
596.
1,596. Are you with me, everybody? So you are now asking yourself, how come if we add this addition, we get 1,650? Or somehow our balance carried forward is 1,596. What have we done? You now remember that they mentioned something about disposal. They said there was a loss on disposal, meaning that there must have been a loss on disposal. Right. Now, get used to this manner of accounting because this is how everybody accounts for PPE now. In accounting for PPE, you have costs. This one is an asset. You have accumulated depreciation. You'll be treating it like a liability. Now, what you do with accumulated depreciation rather, is that year on year, you calculate the depreciation and then you charge it to this accumulated depreciation account. But whenever you buy a new asset, you bring it here. All right. But when you are going to go to the what is it called now? To the SOFP, you take on the carrying amount there. Meaning that whatever value I have here, minus X here, that's what's going to give me the carrying amount. Okay? But we are not going to carrying amount. We are focusing on costs at the PPE at its cost. There was an addition, yet the balance brought forward reduced. So what would have caused that reduction is disposal. So the disposal would have been this amount minus this amount. Is it clear now? So this one now, I'm going to, this is the amount of our disposal. This is the amount of our addition. Number 2 is that we also have accumulated depreciation of this PPE. What was the balance brought forward? Balance brought forward 20x1. Balance brought forward was which amount? Balance brought forward was 224. Are you looking at your SOFP, everybody?
We just have to jot this workings.
You've seen it.
You've seen it? You see
Yes.
224, right? Now, ordinarily, what should increase your accumulated depreciation should be the depreciation charge for the year. And where you will find the depreciation charge for the year ordinarily will be in your P&L, which is this 118 that we have here. So this 118 here is the depreciation charge for the year. All right. If I add these two as well, I get 342. Now, but my balance carried forward for this account in 20x2 was an amount, how much? 318. Now, that tells me that this is the costs. Let me put it this way. Cost of disposed asset or disposed PPE. This is the cost of the PPE that we disposed. Now, here as well, what we have is the accrued depreciation of what? Of the disposed PPE. Accrued depreciation of the disposed PPE. Is it clear, everybody?
No.
Mr.
You can take
Latif,
it again or appreciate.
No, it's not. Though.
I didn't
You
hear
can
you.
take it again. Can
Okay,
you take
good.
it again?
All right,
Thank you.
good. Yeah, I can, definitely. So, what I'm saying is this. We have PPE, but there are 2 accounts. In fact, there are 3 accounts that we use to account for PPE. We have costs, we have accrued depreciation, all right, and then we have depreciation itself. Where will I find depreciation? I will find it on my P&L, all right. Now, what do we do with this account? Normally, what we do with this cost account is that whenever we buy new PPE items, we want to keep recording it at the historical value. So we'll put it here in this cost account. So instead of bringing depreciation to this cost account, we won't take it there. We'll take it to accrued depreciation. So what really increases your accrued depreciation is the depreciation charge. If you want to understand better, what I'm saying is that you debit depreciation, all right, Abi, and then you
Yes.
credit accrued depreciation. You will not take it to cost. You will never take it to cost. Now, when you credit cost is when you dispose. When an item is to be disposed, then we now credit costs, okay? And then we debit disposal. So this disposal we are debiting here is for the cost of the asset. Now, we will not only debit disposal for cost, we will also do the same thing We'll debit to reduce this accrued depreciation. We'll debit accrued depreciation, and then we will credit disposal. Now, this credit to disposal we are doing is the accumulated depreciation of the item we want to dispose. I don't know if you get what I'm saying. Is it clear?
No, it's not. Please, can you use deduct or add instead of this debit and credit? I think it's confusing for me, or I don't know.
Okay. Now, this is what we are saying. If you have an asset, let me do it like this. All the PPE you have an historical amount, a historical cost of 15,000. Depreciation will be charged year on year. What you do with depreciation is this. You will say your depreciation charge for the year, you bring it to your accumulated depreciation. Let's say accumulated depreciation is at 8,500. Or let me reduce it to let's say 7,000. What is the carrying amount according to what Mr. Wasu taught you? The carrying amount of this PPE
8,200.
is 8,000 naira. I said minus 7,000. 8,000
Okay.
naira. Abi? Now,
Yes, sir.
if you now dispose one of these assets, you have here. Remember that the only thing you have recorded here is the costs. The only thing you have recorded here is the accumulated depreciation.
Yes, sir.
What we need to know is the carrying amount of the asset that you have disposed. To now get that amount, you will now ask yourself, this asset that I disposed, what is the cost? Let's say, for instance, the cost is 3,000. I will say minus 3,000 from this cost. Abi? So 3,000 is the cost of what I disposed, cost of PPE disposed. If the accrued depreciation of the PPE I disposed, it is also going to be here, Abi. From inside here, this 7,000, I will need to take it away as well. The accrued depreciation, accumulated depreciation of disposed PPE could be an amount, let's say 1,400. Therefore, the carrying amount of what I have disposed,
1,600.
which will come out of this 8,000, is 1,600. And how do I get that? We say 3,000 minus 1,400. Is this clear up to this point?
Yeah, yes.
Thank you. Ugo. Sorry. Pere, is this clear?
Yes, it is. Thank you.
All right. Or was it not Perry that was asking the question?
It wasn't me, but I mean, it's there. Thank you.
Who was asking the question? I needed to. Was it Abidemi?
Yes, I was the one that asked the question earlier. Thank you.
All right. Now, to move on. If this is the carrying amount, it means it's the worth of the asset. It was 3,000. You have depreciated, meaning that you have accounted for use of that PPE up to 1,400. The worth of that asset in your books is 1,600. If the amount received, or let me call it proceed on disposal of this PPE, on disposal is now 2,000 naira. I want to ask, have we made a gain or loss on disposal?
Again,
Of course, we have made a gain. And the gain is how much? The amount we received minus the the carrying amount, which is 400. But if what we received was 1,200, have we made a gain or a loss?
Yes, that's loss.
We have made a loss of 400. You can see it's a minus already. So that's what we want to do now. I am trying to show you the cost of the item we disposed. I have also shown you the accumulated depreciation of the disposed PPE. What we will now do is this. With this, I can calculate the carrying amount of the PPE that we disposed. I will now compare it to what we must have received. Let's do that now so that we will know what we must have received for this disposed PPE. Because cash flows is really about working back, working back, working back, working back. Now, let's do it together. Now, therefore, carrying amount of disposed PPE will be, what is the cost of disposed PPE? We said it's 54, right?
Mm.
And what is the accrued depreciation of the disposed PPE? We said it's 24. Therefore, the carrying amount
30.
will be 30. Okay? Now, when we compare that to the fact that we made a loss on disposal, the loss on disposal, according to the question, if you go to the P&L, loss on disposal of non-current assets was 18,000. So if we made a loss on disposal, I want to ask you, I think I will ask Janet. Yeah, Janet is my favorite person today. Proceed received would have been how much? The proceed we received for this PP would have been how much? Look at it very well. We made a loss. This is the what.
Mhm.
This is the what. This is the what?
48.
No. Nah. Let's look at if we collected 48. Did we make a gain or loss? If we collected 48, this is the what? 30. We now collected 48. Did we make a gain or loss?
Gain.
Janet, we made a gain if we collected 48.
It's 12.
We didn't collect 48, it's 12 we collected. Thank you very
12.
much. Thank you. God bless you. We collected 12.
I'm not
Did
the
you
one
see how
that
we
said.
got that 12? Did you see how we got that 12? We got that 12 from work back. Because if this is what we add here, then if we made a loss, it means the amount we received must have been less than the carrying amount by 18,000 naira. So that's 12,000. Is it clear, everybody? Is it clear to us, everybody? Okay, so this is what I'm going to do. I am going to take back this loss. We must have deducted it from profit, Abi. So I'll say
Yes.
loss on disposal that we must have deducted from our profit. I'll say, you know what? I'm going to add it back. Why? Because that's not a cash item as well. So when I'm going to take it as a cash item, I will now remember that, it has to do with non-current assets. So therefore, I should bring in that cash that we must have received under investing activity. You will see it when we get there. So the amount here is 12. I'll take in that 12. Okay? That's loss on disposal. All right? What other thing is also a non-cash item? Another non-cash item I will have there, which is also not an operating activity, will be the interest payable. We must have taken loans or we must have done some financing activity where we'll be required to pay interest. Now, the interest is always the interest percentage times the amount, Abi, and any other
Yes.
adjustment. So, but it does not necessarily mean whether we have paid this money or not. We will always put it there, finance cost, because we are doing accrual basis. The expectation is that we have incurred a finance cost. Therefore, we will charge it to POL. We will not wait until we pay. So I'm sure we are not clear whether we have made this interest payment or not. More so, it is also not going to be an operating activity. Like I said, it's going to be, because it's having to do with loan, is a financing activity. All right. Okay. What amount must we have deducted? We deducted 28. So I'm going to add back the 28. All right. Is this clear, everybody? Now, if this is clear, I'm going to add together all of this. Okay. And then I'm going to deal with movement in working capital. This is the easiest part of everything. Movement in working capital. Now, it means that I am going to be looking at current assets and current liability. Now, when I go to my current asset, I'm looking at inventory. Inventory moved from 20 to 24. It moved from 20 to 24. You will agree with me. This is an increase in inventories.
Yeah,
so that I don't forget, anytime I said you do the opposite, increase is supposed to be a plus, but you will do the opposite for asset. Because it's asset, I will take it as a minus. Now, I don't want to spend time explaining why you have to do this, but I want you to keep the rule. Why am I asking you to keep the rule in your head is that when you overthink it, you start. I was a student once, like you, writing this paper. The fact that I overthought about that process made me always almost make mistake until I decided that, you know what, I'm not going to stress myself again. Once it is current asset I'm dealing with, I do the opposite. When I am dealing with current liabilities, I do it as it is. And what's the meaning of that? If there is increase in current assets, I will minus. Instead of plus, I will minus. When there is decrease in current assets, instead of minus, I will plus. If I want to explain that to you, I will just simply tell you so that you don't bother yourself. Whenever assets reduce, it's because you have received money. If inventory reduced, we are going to assume that you have sold goods out and you have received money. When accounts receivable reduce, we are going to assume that your only basis, the people that owe you, they have paid you, so you have received money. But when inventories increase, we are going to assume that you must have spent money in the production or purchasing of those inventories. So therefore, money has gone out. If account receivable also increases, we are assuming that you have given out cash or items that are worth some amount to some customers, and you are yet to receive cash. So therefore, cash went out. So that's the way we look at it. But I don't want you to even use that logic. Just use this simple logic of whenever I'm dealing with assets, I do the opposite. Whenever I'm dealing with liabilities, I take it as it is. All right, quick one. So I don't need to be doing workings here. I'm just going to say 24 minus 20. All right. So yeah, I can have minus 4. All right. Sorry.
So should we add minus or bracket 4? Or jacket the 4?
Jacket your 4. Jacket your 4. My own exam is not in that format. I don't want to waste time.
Okay.
So here, dealing with trade receivables. Okay. For trade receivables, what's the movement we see there?
Increase.
Is it an increase or a decrease? It's an increase as well. 76 minus, okay, let me put this one here. 24 minus 20. Here is going to be 76. 76 minus 58, Abby. Abby?
Minus 56. Minus 56.
58,
Okay, 58. You are
58.
correct. 58.
That will amount to how much? Is that not 18? Minus 18. Okay. Increase in payables. Now, okay, hold on. Let me jump the gun. Now you get to bank. Bank is your bank balance. I have told you your bank balance is a cash and cash equivalent. This is what we want to explain. It is this bank that we are trying to show the movement. So when I'm treating movement in working capital, I am not expected to treat bank, to treat cash, to treat even fixed deposits. I don't know if you get what I'm saying. I am not, that is what we are trying to explain. At the end of the day, it is this bank balance we are trying to walk back to. So you are not expected to do changes in bank. That will be you doing what you are supposed to do last, or what is the essence of what you are doing. You are putting it as part of your solution. So I will omit bank, I will omit cash. If they say cash and cash equivalent, I will omit it as well. I'm going to leave it. Somebody asked the question. What about overdraft? Yes, overdraft. The same thing is referring to my bank balance. It means I have a negative bank balance. Is that negative bank balance I'm trying to walk back to? So I cannot possibly put it as part of my movement. That's why I skipped it. Okay. Now, if I skip that and I go to current liabilities, my current liabilities, I have trade payables, trade payables, trade payables. Okay. So I can say increase in trade payables. What did you say, sir?
Yes, sir.
So what's the increase we see there? It moved from 6 to 12.
12.
So this one, I say don't do opposite. Treat it as you see it. It's an increase. I'll not put it in jacket. I will not put it in jacket. It will be 6. All right. So my changes in working capital will be the sum of all this. It's a minus 16. Lastly, I am going to look at tax paid. The tax that was paid. Now let's do the working for tax paid here. Because the question did not tell me that tax was paid. But we may be able to catch that. Let's look at it. Taxation brought forward. Your tax liability brought forward. 20x1 was how much? According to the question, it was 86. 86. Thank you very much. Now, what would have increased the taxation amount is the tax charge. Many of us don't know the difference between tax paid and the income tax you see on the face of your POL. The income tax that you are seeing on the face of your POL is an estimation. Is an estimation of what the company will pay as tax. It's not what has been paid. When the tax authority come, they are still going to do a desk review and say, Mr. XYZ, you have, don't even let me get to that point. In Nigeria, for instance, I want to talk practice now. In Nigeria, you do self-assessment. Abi, you say, oh, this is what I have estimated. However, even at the point where you have estimated so amount, there might be things like tax credit. There might be things like allowances that are allowable and disallowable. It does not necessarily mean that the amount that you put as charge in your P&L is the same amount you pay as tax. So that's the difference between them. You must understand the one in your P&L does not represent the amount that was actually paid. All right. However, it is expected to increase. If it is a charge, it is expected to increase our tax liability. All right. So I will say income tax charge. How much is charged as income tax in our P&L?
124.
124. Thank you. 124. Now, if this was charged, I am expecting that, our balance should be this amount, 210. However, when you come here, our tax liability in 2022 was a lower amount. And what does that tell me? It tells me that we likely must have paid tax. But how much must we have paid? Now, our balance there is 102. All right? So I'll say tax paid. Then we must have paid an amount, 210 minus 102. That gives me 108. Are you following, everybody? So I'll come here and I'll say tax paid must have been this amount minus 108. Now let me put all of this. I'll do the jacket thing later. Let's move on. All right. So what we have as the cash flows that I have generated? Cash flows generated from activities will be this amount. This is the amount for 26,000. Then I go to the other ones, cash flows from investing activities. All right. Now I shouldn't waste time. The first things I should remember, I must have spent money to buy these additions. They even told me that I paid an amount 90,000. I paid, meaning it's what? Additions, Abi, or I can say acquisition, or I can even, not let me even use all those big words. I can say purchase of new PPE. Purchase of new PPE. How much is that? Purchase of new PPE. It will be minus 90 because it's an outflow. Get used to that one too. Then I'm going to say proceed I received from the PPE I sold. Cash received. Coming. Cash received. We have worked it out already. The cash received is a plus. We received money. Okay. Is there any other investing activity? So this is the point where I begin to say, let me go to my non-current assets. Let me see my non-current assets. Do we have any other non-current assets? We don't. So I can say I'm free to move away from there. But again, I quickly look at my POL. Do I have any interest income? If I'm going to have interest income, then I must have made an investment that will be showing in my non-current assets safe. So there is no interest income. I move on. Okay? And that will mean that what I would have here is...
then nothing is up again now.
What did you say, sir? Were you talking to me? Cash used for investing activities. Now look at my nomenclature. All right. It changed. What changed there? In fact, used for investing activities. This is 78.
What of the loss on disposal of non-current?
Very beautiful. Lovely question. That loss does not represent cash. Do you know? The only cash is what you received. Do you understand? So that's why I'm not treating loss. Yeah. Loss, I have added it back. I have added that loss back to say it does not represent cash, right? So purchase, yeah. I just want to rewrite it in capital letter. I hope that's not mine. Sorry, please. Purchase of new PP. Cash received or disposed. PP. All right. Okay, is it clear, everybody? And then we're going to have, let me put this in bold as well. Bold as well. And then we're going to have cash flows from investing activities. From financing, sorry. Financing activities. All right, I have told you where to look at for this one too. Where did I say you should look at? You look at equities and you look at non-current liabilities. First of all, I'm looking at my equities. I'm seeing share capital increase and I am seeing share premium increase as well. So this is what I'm going to say. There must have been a movement there. Share capital, balance brought forward, 20x1 was 340. Share premium, balance brought forward, 20x1 was how much?
360.
24. Share premium, 24. All right. The two together is giving me how much? 364. Okay. But at the end of the day, my share capital and premium, if I add it together, if I add those two together, it will give me 396. Okay. So what happened? What happened? What caused this increase? We should have had 364 if there was no activity. But there must be something that led us to this. And that will be the what? Issuance of new shares, of which we would have received cash for. All right? Issuance of new shares. So I can say issuance of new shares. And yeah, this will be an inflow. All right? Okay, what else? Again, we were told that we paid dividend. Dividend paid. How much dividend did we pay? 66. Abi?
Mr. Abiodun,
Hello, sir. I'm with you, sir.
are you aware that you just came back online now?
Are you serious?
No, we've
No.
been on.
We have been we have been listening to you.
Maybe
My
it's
own
just
network.
Okay, what's your network then?
Remember, to win the trophy, we need 10 stars. And now we've got 9. How many more do
Must
we
have
need?
been your network.
One more.
But we've not said much. Do you have any challenge?
Stop us.
We just did
Because
the
we
issuance
need
of new shares, I'm sure.
Okay, sir.
All right, let's move on. Now, when you see dividend paid, just to be sure, you can quickly make sense of your retained earnings. How do I mean? What was your retained earnings year before? Can that person help us mute, please? Year before, it was 510. Current year, it is 716. But let's go. Let's analyze. Balance brought forward for retained earnings is this. The only thing that should have caused our retained earnings to increase, we should be profit for the year. If you go and check, what was the profit for the year? The profit for the year was 268. Abi? 268.
Yes.
If you've now paid dividend, you paid dividend of 66 minus 66. Then your balance in the current year should be 716. And that's exactly what we have there. So that tells me that I don't have any other thing to show for that movement in my retained earnings. The examiner has been kind enough, very kind enough, to have told me that dividend was paid. But even if they did not tell me, this is what I would have done. I would have just added this and this. I would have gotten 782. And then I'm looking at the balance, 716. Then I would have said, what is the difference between 782 and 716? And that would be 66. And I would have figured out that dividend paid without their help. Even if they did not help me, I would have gotten it. Is it clear?
Yes.
All right. So I just wanted to show you that it's not part of our workings. Now, the last thing that should be in our workings is this. I said equity. We've looked at everything on equity. We have seen, sorry. Now, we've seen everything on equity. Everything on equity is just share capital, share premium, retained earnings. We're good. When I come to non-current liabilities, there's something I have not looked at, which is long-term liabilities. All right. Now, my long-term liabilities in the initial year, okay, long-term liabilities brought forward was 500,000. Now, in the current year, interest payable, don't forget, that is what is expected to increase your loan term. I said long term, your liabilities, interest payable. Every year you're supposed to pay interest. It's 28, all right? Now, but my long-term liabilities at the end of the year, instead of 528, was an amount 200,000. What does that tell me? Instead of 528, it means I have made some payments, loan repayments. All right? I must have paid to the tune of how much? 328. So I can say loan repayment here. And this would have been an outflow of money. So my cash flows used for financing activities would have been an amount 362,000. All right. Now, my opening balance cash and cash equivalents. Brought forward that much. Go to bank. That's the cash and cash equivalent we have here. Bank. It was 56,000. 56,000. The net cash flows for the year, which will be the addition of the balance we have from the 3 sections. It will be this plus this plus this. That should sum up. That should sum up to cash and cash equivalent that we are carrying forward. All right. Doesn't sum up. We have 48. What we have here is 42. Difference of 6. Did I have this? Let me look at it. Do we have any error at all? Interest payable was 28. Depreciation was 118. The loss on disposal is 18, not 12. 18, not 12. Loss on disposal was 18. So that corrects it for us. And this is our final answer. If you look at your bank, the balance you have there is also 48,000 naira. All right. So this is the introduction class. If you hear any sound now, it is the sound of battery low. Because unfortunately, I can't plug my laptop where I used to take this lecture. Is this clear to us? This is all about walking back. How about now?
Yeah. Fine.
Is this clear, everybody?
What figure affected the net cash flow that dropped it to 8?
Okay, yeah, we took loss on disposal to be 12.
Okay.
Initially, it was 12.
Okay.
So when it was 12, it was giving us 42. So when I looked at loss on disposal and I saw it was 18 from my workings, it returned it to 48.
Okay.
So that's that on that for today. Do you have a date with Mr. Wasu for this Thursday? Do you have a date with him?
He said it.
Can we do Friday then? Can we do Friday? If he's going to take Thursday, I won't drag Thursday with him then. Can we have Friday? I understand how Friday can be for some of us, but if we agree together to have a class on Friday, we can end cash flow on Friday.
Sir.
Is it, sir?
Let me give you one secret. I'll give it to you for free.
Thank you, sir. Give it to me.
If you approach Mr. Wasu as per Thursday, he will succumb. He will give it to you. Okay. He is ready to do that.
Okay. If you guys are ready for Thursday, yeah, no problem. If it is Thursday, you guys are ready. Let me talk to him then. All right. Okay. Thank you. I think I'll save this.
And sorry, sir.
I'm with you.
Okay, ensure that we quickly get this video, because this area of how you calculated that your accumulated depreciation on disposal, I need to go back before we meet on Thursday. So if you can do this video for Thursday, we'll be grateful.
Okay, no problem. No problem. Thank you, everybody. Is there any other question?